Let me ask you something. Are you just totally fed up with constantly losing money using the stochastic indicator exactly the way the beginner textbooks tell you to? I mean, you buy when it hits 20, you sell when it hits 80, and somehow your trading account just keeps bleeding. If that sounds painfully familiar, you are absolutely not alone.
Welcome to this explainer. Today, we're tearing down those amateur trading habits that are draining your portfolio. We're going to build a robust, high-probability swing trading system completely from the ground up. And we're doing it by using a 23-year market veteran, strictly minimalist method. We are taking the noise out of trading and replacing it with pure, structural logic that actually works. Okay, let's dive right into it. Here's our roadmap for today. First, the great stochastic misconception. Then, defining the trend with the 200 EMA. Third, the correct entry strategy. Fourth, cutting losses with ATR. And finally, the risk-to-reward ratio. Let's get started.
Part 1. The Great Stochastic Misconception, or the Trap of the Overbought and Oversold.
We've got to expose a massive conceptual trap here that consistently kills retail accounts. There is a stark contrast in mindset between pros and amateurs. You see, an amateur trader spots a stochastic reading of 80, and they just blindly smash that sell button because the textbook says, hey, the market is overbought. But a professional trader, they approach the indicator completely differently. They only ever look for entries in the exact direction of the already established trend.
Our source material puts it perfectly. Entering trades using only the stochastic indicator is absolutely dangerous. Think about it conceptually. If you're in this aggressive, roaring uptrend, the stochastic indicator is going to look overbought for a very, very long time. Trying to short that market just because a little line hit 80, it's basically stepping in front of a speeding freight train. You're just going to get stopped out over and over again.
Moving on to Part 2, Defining the Trend, the Ultimate Rule Setter.
Look, before you even glance at a stochastic indicator, you absolutely must establish an unshakable rule for your trend direction. That anchor is the 200 EMA, or exponential moving average. It calculates the average price over the last 200 periods, but it places heavier weight on recent data. For swing trading, particularly on a 4-hour chart, this single, simple line definitively dictates your long-term trend. It is the absolute foundation of your trading decisions.
So, here is your golden rule, a mantra you need to internalize. If the price is hanging out above that 200 EMA, you completely ignore every single overbought sell signal from the stochastic. Period. You strictly look for buy setups. The trend is up, so you only trade up. It really is that straightforward. Part 3. The Right Entry Strategy, using stochastic as a precision trigger. Okay, so the trend is firmly set. Now we bring the stochastic back in, not as some standalone magic wand, but as a hyper-precise timing tool. First things first, we clean up our charts, because professionals absolutely despise visual clutter. We keep the top band at 80, bottom at 20. We turn that middle band completely off. We use a standard 14 period, but the real trick here is smoothing the indicator down to just a single line. No crossing lines, no messy visual noise, just one clear cue. And this brilliantly illustrates the exact 4-step entry protocol. Step 1, price stays above the 200 EMA. Step 2, we wait patiently for the price to pull back into a known support zone. Step 3, the stochastic line drops below 20, telling us the pullback is deep. But hold on, we don't buy yet. Step 4 is the actual trigger. We only buy the exact moment the stochastic line crosses back above the 20 level. That specific upward momentum shift, that's your precise entry signal. Which brings us to Part 4, Cutting Losses with ATR, or Building Your Safety Net.
Having a perfect entry protocol is awesome, but without a professional safety net to survive wrong calls, your account will eventually just go to zero. To build that net, we use a tool called ATR, the average true range. It measures the average volatility and fluctuation of an asset over time. Placing a stop loss directly right under a swing low is what amateurs do, and it leaves you totally vulnerable to getting kicked out by random market noise. We have to give the trade intelligent breathing room.
So what's the actual mathematical formula for survival here? A professional stop loss equals your recent swing low minus 1 to 2 ATR. By subtracting that average true range value from your recent low, you're placing your stop safely outside the zone of those random, volatile price wicks. You get to stay in the trade while the market naturally breathes and fluctuates.
But hey, let's be totally real for a second. As our veteran source says, you can't constantly make a profit every single time. We will get stopped out too.
That is some real talk. Even with the perfect trend, the perfect pullback, and an ATR safety net, stop-outs are just going to happen. Accepting this fact is what builds the mental discipline to rigorously stick to your rules without panicking.
Part 5. The risk and reward ratio. Making the math actually work for you. The whole point of this system is to ensure the mathematical expectation is heavily skewed in your favor, which completely negates those inevitable stop-outs we just talked about. 1.5. This single number is your golden rule. For every single unit of risk you take on a trade, this minimalist system rigorously demands a minimum of 1.5 units of reward. If you can't logically map out that ratio on a setup, you simply walk away. You do not take the trade.
Let's put that into perspective. If your stop loss mathematically represents a $10 drop, thanks to that ATR padding, your target has to be at least a $15 gain. If you're risking 40 pips on a Forex pair, you need a clear path to a 60 pip take profit. This 1 to 1.5 ratio is exactly what absorbs your losses and keeps you profitable over a large sample size of swing trades. It literally takes the emotional pressure off needing to be right all the time.
So the crucial point is the professional checklist, surviving the markets.
Listen, trading really doesn't have to be this chaotic mess of contradictory signals. We've just built a clean, logical framework together. Here are your core rules for survival. Number 1, do not clutter your chart. Stay far away from the indicator graveyard. 2, always follow the 200 EMA trend. 3, use a smooth stochastic solely as an entry trigger when it crosses back out of extreme zones. 4, accept your stop losses but pad them intelligently with the ATR. And lastly, rigorously demand a 1 to 1.5 minimum risk-to-reward ratio. Following these rules without exception is exactly what separates the professionals from the gamblers.
So, are you ready to clear that indicator graveyard off your charts and finally trade the trend? I challenge you to stop overcomplicating your screens today. Trust the minimalist structure we outlined, respect the math of your risk, and keep exploring the deep mechanics of professional markets. Because when you simplify your trading, you truly amplify your focus. See you next time.